Property Unfiltered. Real investors, real stories, the good and the bad in property investing.
Well, good day everyone, it's Liam Garman here, Managing Editor of Real Estate here at Momentum Media, the team that brings you the Property Unfiltered podcast. And today I'm with my co-host Simon Loo, founder of House Finder. Mate, how you going?
I'm good. A little bit dusty.
A little bit dusty
A little bit tired.
From your Christmas party.
Yeah, we had our Christmas party on Friday, which is always interesting.
Yeah, I know. At what time did you wrap up? Tell us. 10 p.m.
Before dawn.
Before dawn. That's good.
Before
and
light.
For people that are watching this, I'm wearing a shirt now, like a t-shirt, because last time I was so embarrassed with that first podcast that I wore a button up, and so I was like, I've got to dust off the old, like the nice knit. So I thought,
look great. You look great as always.
Yeah, I was inspired by you. But look, today we're talking to our amazing guest and getting some of his insights.
Yeah.
Taku Ekanayake, director and founder of Kin Financial. Mate, welcome to the podcast.
Thank you, mate. Thanks for having us.
And this isn't the first time you've been in this studio.
No, probably about 8 years ago.
8 years ago.
But it's definitely a different setting from what I remember.
Yeah,
I think I was standing last time.
Yeah, it's gone downhill because Simon and I
definitely hasn't. A lot of brighter lights, I can say.
Yeah, well, I know. We'll get dehydrated. And, we're talking before the podcast, and it's funny that when someone with your level of expertise comes onto the podcast, and we're talking about your journey and everything that you've been through, and we were having a bit of a joke before that, in your line of work, you always speak to your clients and people that you're helping on their journey, trying to find their financial goals and their property goals, and you help them, but no one ever asks you.
Yeah, true.
You're like the therapist.
Yeah, exactly. So always listening to their goals and what they want to achieve and all of that. And then when the tables are turned, let's see how it all goes.
Yeah.
So.
It's like you're in a confessional at the moment. Yeah. But look, to start us off, Simon, Taku, how'd you guys meet? Like, what's the background here?
Man, we've known each other for so long.
Gone back many years.
We've been through many journeys together, up and down, work, out of work. Out of work.
Recently, the Christmas party.
That's it. You seem to be faring a lot better than I am. So that's you. But no, look, we started off as property investors through Property Chat. It's us and a small group of investors and brokers. We used to just hang out, and these guys were aspiring brokers. I was an aspiring buyer's agent. And I remember once going up to the Gold Coast with Taku. It's probably the first time we properly met. And we were at this like seminar. I forgot his name, but you know that guy?
Yeah, it was
that
it's like a motivational seminar.
Yeah.
Property, not property, but like personal development, growth sort of thing. Yeah.
It was one of those seminars where you shout his name. Like,
everyone sounds
like a Tony Robbins.
Yeah, exactly. But no, it was very good. And, we kind of just hung out, and, a lot of mutual interests, obviously property related, and, kept buying properties. He was buying properties, I was buying properties. He became a broker, I became a buyer's agent. So that kind of like a lot of sort of mutual clients kind of gelled as well.
Yeah.
And we started off working in the same office. We
did.
started sharing offices as well. So he needed a space and I needed a space because I can't work from home. I've got like attention span issues. And the very first office we had was this dingy little sort of shared office space in, where was it? Ultima, I think it was. Chippendale. That's it.
Nice.
Yeah.
I still have PTSD from that office, I think.
It was like every day we walked in, there was like a fresh dead cockroach on the floor. That kind
no
of
windows, no ventilation.
Don't slam the door, the asbestos will come down.
Yeah. I remember I was thinking, you know what, this is a good spot to start with.
Yeah.
Because this is a good rock bottom. This is like a good, you
Can't
can only
get
go
much
from
worse.
here. Yeah. It's good motivation because, you kind of aspire to have a window and no cockroaches and stuff like that. And then we got out of there quickly, and we've had a few other offices since.
Yes.
But no, it's been quite a journey, man.
It has indeed. Yeah. From our corporate roles into building the business and everything. Yeah. How life's changed for sure.
It is cool because now, Simon, this is our second podcast together that we've done. And one thing that I really enjoy with these podcasts is you're bringing in your people that you work with, that A team. And last podcast, you and I were talking about the need for investors, or even say like a first-time home buyer, to surround themselves with an A team that can help them on their journey.
Yeah.
You get the buyer's agent, you start there, who will do the research. They'll help you find the right place that's fitting your goals. And then sliding in with a mortgage broker such as Taku, who you trust, that they're going to get the best outcome for your clients. And it's really awesome to see you guys working together like that to help investors really through the entirety of their journey from looking right till the settlement date.
Yeah. I mean, it's I think it's a common theme. Like, everyone says, having the best team around you is super important. It is. Like there's so many variables in property. It's not just the fact that I find a property and he gets the money for it. What about who manages it? What about who looks after it when something goes wrong, like trades and stuff like that? What about legally, your solicitor, your conveyancer? What about all the other peripherals, like your building and pest guys, your depreciation guys, who you use for insurance, and then your network as well. Like you kind of want to work with people who are on the same journey with you, on a property front, personal front, business front. And we've definitely shared that together as well, and we've got a lot of mutual clients that are kind of doing that. But one thing I really like about Taku is, like with most of all the guests that I have on, is they walk the walk before they try and give advice. So Taku's got, I'm sure a lot of listeners know who you are. You've been on a few sort of news articles and
back in the day
and things like that. But he's got a pretty impressive property journey. He's bought and sold and owned a lot of properties. A lot of success and a lot of failures and so on as well.
for sure, 100%.
So maybe you can give us a bit of a rundown on how it all
journey,
started.
yeah.
Yeah.
How it all started.
Yeah.
So it would have probably been, I think the first property I purchased was about 2017-ish period. So about 7-8 years ago. But previous to that though, like I hadn't really had any sort of thought about investing in property. And before I started my brokerage, I'd chosen a path down after university around a corporate gig in terms of sales and everything. And during that period of my life, when I was in my early 20s, like all I was focusing on was, earning the commission checks to blow it on the weekends and really just unproductive things and all of that. And I had a pretty significant moment in my life in my early 20s, around 23 going on to 24, where I lost my mum at the time. And that actually really helped shape the way I started to think as well, because firstly, I really realized that life was short. You can come up for you at any given time. And if you really want to create the life you want to have, then, sometimes you have to make those sacrifices that most people aren't willing to make. And time's ticking and you better really start and stop messing around in what you've been doing previously. So from that moment on, I really took myself out of that situation of the nightlife and going out, and really spent the time that I saved from not doing that into, personal development and, changing my mindset. And also at that time as well, I picked up a second job as well. And that was where I started the Uber driving as well. And that was just instant
Which
cash.
is what you got a few headlines for.
Yeah, that's right. That's right. And that's where it was instant cash flow. And then, really just went gung-ho at, focusing on trying to get that first deposit for that first investment property. And then 3 to 4 years after that, so I was about that 27 years of age, that's when I first purchased my first property. And I was tossing up between two areas at the time. So around that Melbourne outer ring area, Brisbane outer ring area. My broker at the time, he told me my borrowing capacity was about 430K. And I was tossing up, okay, which area do I want to go in? One thing about Melbourne, it had historically low yields at about 3.5%. I wasn't on a high income at the time either. So I decided to go down the Brisbane route, where it was about 6% yields for that 400K mark. I settled on a place in an area called Brackenridge, which is in the Brisbane City Council, just about 20 kilometres north.
Oh, yeah.
Yeah. And then in hindsight, though, pretty much as soon as I bought, Melbourne doubled overnight, 2-3 years after it doubled. Brisbane stayed flat for a couple of years. So from there on, I didn't really have too much of a strategy into how to get to that next purchase, or I didn't even really understand the idea of, how to manufacture equity or pull out the equity. So about a year after that, while I was still continuing to, save up for that next deposit, I went back to my old mortgage broker, asked for a valuation, only came back 10K higher than what I purchased it for. So that was a bit of a bummer. So I was like, okay, can't really do anything now. So just continue to keep saving as much as possible and, working those multiple jobs. But then also around at that same time, I came across on a property forum and another guest that you've had on here, Michael Shah, on the channel, who we're really good mates of.
Yeah.
So I reached out to him because he had built a really successful property portfolio and caught up for coffee with him. And it turned out he was becoming a mortgage broker at the time as well. And immediately from that meeting, the conversation I had with him versus my old mortgage broker was completely different. The first mortgage broker was very transactional. It was more like, okay, how much do you have in savings? What's your income? Okay, this is your borrowing capacity. Go off and here's your pre-approval. Whereas with Michael, he didn't even focus about my next purchase or my property. It was more so about the long-term goal and where do I want to get to? What sort of asset base do I want to create? What sort of passive income do I want to get to? And he also helped me with a long-term strategy in terms of how to maximize my borrowing capacity and things like that. So that really opened up my eyes from that point on. And even just from that conversation as well, because he looked at my property and then I was like, don't have much equity in it, so can't really do anything now. And he suggested, hey, why not we get multiple valuations from multiple banks? And I didn't even know that was a thing. That's how green I was, that you could do multiple valuations, things like that. So him just going above and beyond what a normal mortgage broker did was really was the difference between me being stuck at one and having to wait or continue on my journey to build out a property portfolio. So
Yeah, nice.
Yeah, I was taking notes throughout that, and I took a lot of things away. Firstly, starting your journey 7 or 8 years ago, that is actually quite recent in the scheme of things. There are a lot of property investors now that are kicking themselves. And sure, investing before 2020 would have been optimal, but the second best time, I think, reasonably is now. What most data is saying. So you jumped on it recently. It's really not over for people who haven't started their investing journey yet. And the second one is Brisbane versus Melbourne. And Simon, this is something that we've discussed in the past as well about holding that property is for the long term. You have to hold to get past those cycles because Breckenridge is quite close to Brisbane CBD. Like that is a good investment. That's going to be giving you some really good returns into the future and really good capital growth. So actually quite a good buy in retrospect.
Yeah, I mean the stats here, like you pay $415 for it, and it's worth currently about $870, $890, something like that. And there was only how long has it been? Like less than
7 years.
7 years or so. Yeah. But the difference, I think, like one of the things you mentioned, the reason why I didn't buy Melbourne was the yields were so bad, right?
Yeah, exactly.
I mean, I don't think, like, for a normal investor, if the yields are particularly bad, you can't hold on to a property for 7 years. You can't wait it out. So, even though Melbourne may have gotten a little bit quicker gains, but at least with...
You might have had to have sold it anyway.
Yeah, exactly.
So you're back at square zero. Yeah. And the third one that I took was... working with your brokers and them helping you on their journey. And the first one was a transaction. You can do this and see you later. I'll talk to you later, Taku, for the next time I'll get my commission from you. Versus the second broker you had, it was like, okay, cool. What's your long-term goal? Let's take the steps to get there. Having worked with other brokers in the past, and now you as a broker yourself, are there any lessons that you've learned from working with other brokers that you've looked at and you've said, for my clients, I'm going to do it differently. I'm going to learn from that mistake from a broker that I've seen in the past, and I'm going to help my clients by learning that mistake. Are there any mistakes you picked up from other brokers?
Yeah, absolutely. Because especially when you're first getting into property, you're so excited about wanting to get onto the property ladder and purchase. And that's really all you're really thinking about. So the first broker that tells you can get this X amount, you might just go to, right? Because he's like, yes, I can get this much amount, and that's my ticket to get the property. But let's just slow it down a little bit. Let's focus on the long-term goal first and really create a strategy in place in terms of how we're going to get there and work our way backwards from there and where we are today. So I feel as though if a broker in the first call is not asking you about your long-term goals, then run for the hills because, without that, then you're going to get stuck in the mud at some point in time.
You'll notice, like, when I do this show, a lot of the guests I have on are brokers. And I always say this, like the broker is more important than me. I can find amazing deals all day long, but if you can't buy them, what's the point?
Yeah, it's a moot point, right? Yeah.
So like having a good broker is so, so important. Like you set yourself up not just for the next house. Most people, when they go to a broker, it's about how much you can borrow. And the other big thing is how low can you get my interest rate?
Yeah.
Like, if you're getting a $500,000 loan for a property, let's say you have to pay 1% more, which for a lot of people out there will be completely ridiculous, especially if there is a 1% less option on the table. But 1%, like, okay, $5,000. I'm not saying it's not a lot of money, but if paying that slightly high interest enables you to buy another 4 or 5 properties, where each of those properties are making you from 415 to what? Doubling in value in less than 10 years. Like, really, it's just the cost of doing business. So I think a good broker will not only help you put that into perspective, but also help you plan out, okay, cool. For you to be able to get your next 5 properties, you need to use this bank first because of this particular policy or this particular reason. And then we need to start using second-tier lenders or third-tier lenders and all this kind of stuff that people like to stay away from because they've got this sort of iffy feeling, unless it's not CBA, ANZ, Westpac, or what's the other one? NAB.
Yeah.
So yeah, no, I totally agree with finding a super good broker to work with.
What are your thoughts on second tier lenders? Like, I don't personally have a problem with it by any means, but I know this is something that I've worked through with my broker, where it's like, a lot of people get a little bit cautious around it. I'm like, I don't know why they're giving me such a much better rate. Why do people get cautious over it?
I mean, they definitely serve a place in the market, especially in this environment where, rates have gone up, borrowing capacity gets strung up real quickly. And yes, you might have to pay an extra 1 or 2%, but it's just short-term solution to be able to get into the property market now, while not as many people are in the market before rates start to come back down and then property prices go crazy, right? And then if the if the rates start to come back down again, then we can shift you back over to your tier 1 lenders. So just use them for when you need to, like really just take advantage of what they're offering you, Yeah.
The mindset is like, focus on the deal. If there's a deal that's going to make you money, you should do whatever it takes to get it. But that includes getting a deposit together or using a particular bank, even temporarily. I think that's really the attitude or the mindset that people should have, especially if they want to build passive income. It is a barrier, but once you get over it, it's kind of like, okay, cool, it's just another bank. You make the same repayments to the same, money comes out. It's exactly the same thing, pretty much.
Yeah.
So
I think it could be daunting for first-time investors, maybe if they've only got 1 or 2 properties and, it's a logo that they've never seen or never heard of, and maybe their parents or someone in their ear saying, don't go there, they'll like increase your rates as soon as you get in, a mortgage with them. But most investors, once they start, having a portfolio, they get it. Like they know that they're going to have to utilize them from the eventually. And when we do our roadmap and our strategy session as well, because we're usually modeling it out for multiple properties, in that journey of that roadmap, those lenders are in that journey as well. So
don't use the smaller banks. It'll be a run on the ATMs and they'll
exactly.
Now let's look at your specific property, some of your highlights, your downfalls, your mistakes, your losses. Talk us through that journey and some specific examples of what you've done right and what you've done wrong.
Yeah, cool. So how I mentioned, so after I met Michael and then he ordered a bunch of valuations for me. So it turned out one of those valuations, it actually came in $60K higher than pretty much all the other valuations that I got. So with that and the savings that I had, that was enough to get me onto the second property. Yeah. And with that second property, and after speaking with Michael a few times as well, I decided on a cosmetic renovation strategy as well, because a lot of the areas that I was looking in was relatively flat and I couldn't afford on, the organic growth of the market. So finding properties undervalued, but then also maybe just adding a bit like 10 to 15K to give it a bit of an equity uplift, but also a rental increase as well, enabled me to continue to purchase multiple properties within a short period of time. So the second property I purchased was in an area up northern Queensland called Deception Bay.
I know Deception Bay. Yeah.
D-Bay.
I know.
Some may say Depression Bay.
I know. It's almost like, if I could give, because is that Moreton Bay Council? Or
It is
Moreton Bay Council.
Yeah.
If I could give Moreton Bay Council any kind of tip, it's like maybe consider a rename from Deception Bay.
Yes.
Like Beautiful Bay or something. And then you'd see their house prices there double pretty quick. But yeah, sorry, take us away.
Yeah, so after that one, and I did the renos, and then I quickly 3 months after pulled out more equity and purchased in Kalanga. So that's also in the Moreton Bay region. So it's a bit of a theme there.
Yeah.
I focused really on that specific area. So it went from like Brackenridge, but then went up a little bit north and north. And it was also because, borrowing capacity had something to do with it as well. And the yields as well helped as well.
I can't believe you paid $253,000 for a house in Kalanga.
Yeah.
The houses we're seeing there at the moment, is ridiculous.
Yeah.
250K for Kalanga was a bargain. Even back in 2017, the value is now 678.
Yeah.
But I actually think it's probably higher than that.
Yeah, it could be.
Because
Yeah.
these are the vowels that you provided are just
desktop vowels.
Desktop vowels,
yeah.
and they're usually quite conservative. But no, that's crazy. That's what, more than almost triple in value.
And then Scarborough 2021.
Yeah, so I actually had a few more purchases before that, which I went on to end up selling as well, which was probably a mistake in hindsight. But in between that 2017-2018 period, I purchased a few more properties in Kalanga, Eagleby, which is in Logan, and one in Salisbury, which is in South Australia. And, I was mentioning that, the market wasn't doing too much at the time as well. And I started to second guess myself, and I let those negative voices come in my ear. And just before COVID, so around 2020, I think it was around that time, I ended up selling 3 properties for no reason. It's not like I needed the cash to do anything with it, right? So I ended up selling it just at breaking even. But then as soon as COVID hit, the market just went crazy, and it was just doubled in value. So,
And were you a mortgage broker by this point?
yeah, I was. Yeah. So
What was the lesson there, in terms of selling?
don't be so impatient. Property is it's a long-term game. And I understand, sometimes you can get instant equity, so to speak, but sometimes you just got to wait it out a little bit. And if you've done your research, and if you've done your checks and all your due diligence, and if you don't need the cash for anything else, then just hold on to it.
Yeah.
It will perform over the long run.
I actually remember your Eagleby house. I remember sitting there in the office. We were talking about it. I was giving you a bit of crap about that house. It was. I think it needed quite a bit of work. It was one of those older sort of fibro high sets.
Yep.
And I got a few of those now. Right, they're kind of dilapidated, and actually, I think at least one of them is just empty. I don't even have tenants in there. And this isn't something that I expect all investors to be able to do. But for me, instead of, because I still believe that this particular property has still room to grow, rather than just, rent it out and risk all the tenancy and issues and all that kind of stuff that comes with it, I'm just going to hold on to it. And then eventually, if the time is right, I'll do a proper renovation on it and sell it, and maybe have less regrets, I guess you can say. But it's a common theme I hear a lot with investors that, sometimes there's so many things working against you as an investor, especially if you're one that's holding property. All you're dealing with is negativity, right? Whether it is maintenance issues or tenancy issues or, whether you're dealing with the doom and gloom in the news, during COVID. Whichever way you look at it, there was a lot of fear about the unknown.
Well, of course. I mean, everyone was kind of looking at this flu that everyone thought, the population's gonna go off a cliff and there'd be economic catastrophe.
Yeah.
Which never happened. And at the time, everyone thought the same thing.
Yeah.
Is my job? Am I ever going to have a job in 24 hours?
Yeah.
So of course there's going to be that level of
and then your family, your friends, everyone's sort of going, oh, you should be doing this, you shouldn't be doing this, blah blah blah. So it's so easy.
You should only invest in Sydney. There was a stigma where Sydney was the only market that always increased in value, and all other markets were just dead.
Yeah.
I don't want to maybe allude to an internet personality too much, just in case I get an angry email or an angry text in the next 24 hours. But I mean, there was someone that I was talking to my wife about this, and we were talking about buying in Brisbane. She's like, no, don't buy in Brisbane, don't buy in Brisbane. this internet charlatan, I'll call him. He's like, oh, if you're buying in Brisbane to then buy a nice owner occupier in Sydney. Sydney's going up so much more rapidly than Brisbane is, and it's going to go up so much more that if you buy in Brisbane, you'll just forfeit the Sydney market forever, because forever Sydney will be that much higher. Well, hasn't that proven to be wrong?
Yeah,
Like,
might have few regrets.
yeah, and that's the thing, because it's like, because if you buy in Brisbane, the Sydney market will get away from you. If that's where you park your equity, it'll get away from you.
No, it's
not really.
Yep.
And that caused about a week's. This was probably 8 months ago. That was about a week's worth of arguments between me and my wife at home over an Instagram post.
Yeah, right.
Yeah, so, but look, there are downsides to the Brisbane market, as we're going to get onto in a second. Your Morningside place.
Yep.
Flood zone.
Oh man.
Morningside.
Yeah,
You
Morningside.
wanna share a bit of it?
Yeah. So, not the same office. Like, you're seeing the stuff that we do, the deals that we're doing, and all this kind of stuff. And every now and then, like, we come across these houses where they, on the face of it, and even if you dig a bit deeper, they're dumps.
Yeah,
right?
okay.
And, a lot of my...
Tell me what you really think,
Oh, honestly, they're older, they might need a bit of work, they might have a few compromises. And for me, it's sometimes, my clients, by and large, they want good deals, they want below market value, all that kind of stuff. And I tell, people, don't get emotional about properties. It's all about the numbers, blah, blah, blah. But especially for new investors, it's really hard to get their head around that. They still want the 422, 500 square meter, little bit of, cosmetic stuff is fine, but nothing major, this and that. But this house, I actually sent this house to a few buyers and had it knocked back. And then Taku was in the room, and he was like, you know what? I think I can go for it. I think I can buy it. Because I could get... Okay, so this house was a house in Morningside, which is a pretty premium suburb in Brisbane.
It's probably, what is it, 8 kilometres from...
8 kilometres.
Oh, nice.
Yeah.
CBD.
Right, yep.
Yeah.
Was at the
Like
bottom...
mediums, you can't get anything under 1 mil there
Now.
for a 3-bedder.
Yeah.
Oh, no, back then you can't.
Back
now,
then, yeah, now it's like well
like
above.
2-3 mil.
Yeah.
Like,
Yeah,
it's
right,
ridiculous.
right.
It's gone crazy. This was back in 2023.
Yep.
Right? So in
Start of
2024,
2023, yeah.
Let's say about 2 years ago.
Yeah.
Right? It's an older sort of fibro house. I remember it at the bottom of a valley, which is one of the problems, because we say we never buy in flood zones ever. But part of the back, there was like a slither, because it backs onto like an overland flow path.
Yeah.
So there was a little bit on the back that was in a flood zone. But because the block sloped back a little bit, like, it kind of wouldn't have affected the house. The house is like an older house on stilts.
So the house at the front was higher than the backyard at
Yeah.
the back.
Yeah.
Significantly.
Yeah.
So there was compromises, but I was like, you know what, I can buy we bought it for $700,000.
Oh, yeah, nice.
Yeah.
700 grand.
Or not, maybe not. I don't know the end of the story.
At the time, the valuation that you did on it was how much was it?
1.05.
1.05. So at the time, we paid 700, and the valuation that came back at purchase was over $300,000 more.
Yeah.
And I'm like, does the flood, flood zone, surely. Let's say the flood zone affects 50 grand or 100 grand of the value, not 300. So that was a good deal.
The other thing was it needed a bit of work.
Yeah,
Yeah,
it did.
so the vendor ran out of money, so he was
Mid-renovation.
mid-renos.
Oh,
needed
so you
probably
couldn't
about
just move in
20K.
straight away.
Yeah, exactly.
Yeah, okay.
So it was essentially like a fire sale, because he couldn't make make it to a point where it was relatively habitable as well. So there was a few things wrong with it.
Yeah.
But just after crunching the numbers and just looking at the deal, and by this point I'd purchased multiple properties as well, so I wasn't like that first time investor that was very cautious with every little
I remember. I remember it. I was like, oh no, this house needs a bit of work, and I told you, and you're like,
So you bought it. You bought it, Simon. You found it.
yeah.
Yeah. Okay. And
Yeah,
you were
through
working,
house
was this when you work in the same office?
Yeah, it was. Yeah.
Well, that makes sense.
And it's a cracker deal.
Yeah.
It would have been something that I would have bought myself if I was in the market for that kind of stuff. But and interesting when you mentioned it was needed renovation. The guy was a plumber. I remember the seller was a plumber.
Yeah.
So it was a tradie himself, but I don't know why he didn't just finish it off.
Yeah.
I think there was like a bit of conversion down the bottom. Like there was a few rooms that just needed like extra wardrobes or something like that. But anyway, How much did it cost? Like the reno? Like the rest of it?
Less than 20.
Yeah,
Less than 20 grand.
Less than 20. And then a couple months after, pulled out, I think, over 250K of equity.
Yep.
Which helped me with that, like 2 months after, and then purchased my next 2 properties after that.
Yeah,
so
done.
That's good.
even though I've got a slightly flood zone property, it allowed me to get 2 more purchases after that. So, yeah.
I mean, sometimes you have to be. This is pure unemotional investing.
Yeah.
Yeah.
You know, people freak out when they hear flood zones, especially with all the rains and stuff that's been happening in recent years, and rightly so, right? Like you should and you shouldn't. You should be afraid of buying in flood zones because of the perception, because of the potential insurance premiums. We checked the insurances; it came back fine. So when you do your due diligence and you go, okay, cool, yeah, okay, there's a few compromises, but I'm getting it for so cheap that it's so like the value is so much beyond these compromises, and now it's worth like the CBA the desktop valuation came back at 1.209
and that's a current one. A
Yeah,
current valuation,
less than 2 years.
1.209.
Yeah.
Yeah,
That's
wow.
like so 8, 9, 10, like what was it, 500 grand, something like
Yeah.
that.
Yeah.
You know, of profit in less than 2 years.
And it hasn't had any flood since.
Yeah,
at
no
all,
issues. Yeah.
I mean, there was was there a flood event? I think there was a flood event in
I feel like
Brisbane.
Brisbane always has got flood events.
Yeah, they
Yeah.
do. Just, yeah. Well,
So,
not that
I mean,
it affected the property anyway. But
This hasn't
yeah.
affected the property now.
Yeah,
You might
exactly.
you might be
Knock on
okay.
wood.
So that
Yeah.
was huge. That was huge. And I think, like, you know, following from that, I think every single house you need to buy just needs to have that kind of,
Yeah.
you know, that sort of instant equity, like I always keep saying.
Yeah.
But this is in practice, you know, this is reality. And it's in a premium area. A lot of people think these, like, you know, instant equity deals only happen in really sort of, you know, not desirable.
Yeah.
But Morningside, like, ask anyone about Morningside, it's
People are going to know
Yeah,
if they're from
a proper
Brisbane,
area.
or if they're looking to buy in Brisbane, or if
Yeah.
they're looking to rent in Brisbane.
a good spot.
Now, like, I quite like that you guys work together like this. You've shared office spaces in the past. You share your expertise with each other. And you know, when we were buying our last place, my wife and I, we used our buyer's agent knew our mortgage broker, which made our life so much easier because we decided on a place and then they just kind of spoke to each other and did it all behind the scenes. And
Yeah.
it feels quite good for and I know you guys have got a few mutual clients, which we'll talk about now, that they're probably experiencing the same kind of benefits of, as Simon and you and I always talk about, surrounding yourself with that A team that can support people on their journey. And Simon, you can find the best deals. Taku, you can execute it and you can make sure they get over the line. And you guys have that all stitched up. Talk us through your mutual clients and some people that you've helped on their journey.
Look, I'm just going to talk, because we might be running out of time. We're just going to talk about one particular client who's bought 2, 3, 4.
They did 9, didn't they?
8, 9 deals.
There you go. You have to count it. You almost run out of fingers by the end.
In the space of the first was in 2019, in 2019. So around about 5 years or so.
So almost one every 6 months.
Yeah, one every 6 months.
that's-
Yeah,
Yeah.
nice.
I mean, I never thought of it like that, but that's
Yeah,
from
me
that
either.
perspective, that's pretty.
So
that's
I mean,
pretty crazy.
look, there are going to be doubters that are listening to this podcast. Are they high earners, or are we just talking about they're taking the equity, they're reinvesting, taking the equity, reinvesting? How is
I actually
it?
don't know how much they earn, but I mean, they're both 9 to 5.
Yeah,
you
9
know.
to 5, just corporate.
We're not talking about
Yeah.
CEOs here.
No,
Yeah.
not at all.
Yeah.
I mean, I won't mention the names, so we can talk about some rough numbers. I mean, what would you say? Like maybe 200-300 grand combined?
Yeah, probably
income?
300.
Yep.
Yeah,
Yeah,
income. They've got
something
2
like that.
kids. They've got an owner rock as well. And
yeah.
then, yeah, obviously those investment properties.
Yeah.
But it's really just, and you'll be surprised how you can maximize borrowing capacity by just utilizing those, you know, tier 2, tier 3 lenders. And, you know, that's the difference with, you know, being able to be stuck with maybe 2, 3 properties with the majors or the tier 1s versus, you know, really extending yourself and, you know, in a reasonable manner and being able to build out a very successful investment portfolio as well.
I mean, because that fraction of a percent sums to, you know, could be $200 a month or something,
Yep.
which, you know, when you're juggling multiple at the same time, really adds up every month. And then when you sum it over the course of a year, it makes a massive difference.
Yeah.
Yeah.
Yeah,
When
absolutely.
you're working in the margins like that. So talk to me, how did you guys work together to get them?
Well, the first
to get them
house
nine?
was in Kalanga again, in Queensland.
There's a theme here.
There's a theme, yeah. We've targeted particular areas. Like I don't want the areas there is a lot of science in the areas we pick.
Yeah.
We're not just like, oh yeah, Moreton Bay, Kalanga, near the water, seems pretty good. You know, when we started buying in areas like Kalanga, we noticed that like anyone who knows Brisbane longer than 10 years knows that Kalanga, Petrie, that entire pocket used to be pretty low socio.
Yep.
It used to be a pretty big sort of, you know, a lot of sort of unemployment and, you know, crime and that kind of thing. And back then it had that stigma. So when we were buying heaps in Kalanga, a lot of people were like, ew, I don't want to buy in Kalanga. But, you know, these houses, you know, like Taku bought his for 250. We bought this one for 400. This was end of 2019. I think it's settled in 2020, but, you know, right at the end of 2019. And the valuation now is 827.
Yeah.
You know, it was a 4-bed, 2-bath, 2 garage, one of those sort of, look like a house land package, but maybe like at the moment, maybe 20, 25 years old, one of those sort of, you know, just standard brick houses, tanks of properties.
Low maintenance.
Low maintenance.
And some of these WA figures that you've got coming through, so you've got multiple of these properties that were purchased in 2022, 2023, 2024 that have gone up, you know, 30, 40%.
Yeah.
In we're talking, you know, like a dozen months a year.
Insane,
You know, like
yeah.
it's really not.
Yeah, and look, once you get the bug, I think, you know, if you buy a house and literally within months you're making a couple of $100,000 of tangible profit. So this is money you can buy stuff with, you know. I think you can start to think, okay, cool, you know, we need to go as hard as possible.
Yeah.
So I know these particular clients on a personal level as well, and they were never, you know, from as far as I remember, they were never sort of super aggressive or anything like that. But
As
you know,
investors?
as investors, yeah.
Yeah.
You know, but I think they had the same aspirations of going, okay, cool, I want to have more time with kids. I want to, you know, take a step back from work, blah, blah, blah. And everyone has that aspiration, but very few people have that commitment. And I find you only get that commitment when you start seeing the results from each of those houses. And you go, okay, cool, now I can do the numbers, right? If every house I buy, let's say conservatively just makes me 200-300 grand over a 5 to 10 year period, I just need to do this X amount of times, then I'm going to have X million dollars. With X million dollars, I can have X amount of properties paid off, and that's my 150K equity, passive income, or however much I wanted, and then I can quit my job. So then it becomes a race. How do I get there quicker? You know, initially you might think, oh, I want to do it when I'm 50. But then when you buy one property, we bought that in 2019, and then the next one was about a year later. But then that year he bought 2 properties, and then 3 the year after that. So you kind of just went,
It's kind of getting exponential.
Yeah, exactly.
And these aren't properties that you're doing renovations or anything on either. So it's literally just you put the deposit in, the cost for buyer's agent, stamp duty, that, and then a few months later, you know, because it's bought so well.
Yeah, I don't remember one that we did a big reno. I remember having conversations, you know, because I stay in touch with most of my clients that need constant advice and things like that, and you know, I'm happy for them to reach out to me. And a lot of my clients, whenever something needs work, they always go, hey, would you do this, or how would you do this?
Yeah.
You know, there were a few that needed maybe similar, maybe like 10K or less, something like that, just to fix up. Because a lot of these off markets we get, they're not in a sellable condition.
Yeah.
A lot of properties that go online, there's some guys just gone through and just painted
But
everything
you know,
white.
when you're talking about like several $100,000
Exactly.
investment here, you know, 10,000. Actually, again, this is what we were talking about before. You know, cutting corners actually costs you in the long run. You know, it's $10,000 really is a reasonable price here.
Yeah. So every time we bought, we pulled out 100+ K equity, 200K equity, and he's just kept using that deposit to keep buying again. This guy's, I don't know what he does. I don't ask because it's just going to go over my head. But he's just managed to keep getting money out, keep getting money out.
Yeah.
And he's just kept building. And look, at the moment, he's got the option, really. He's got a few $1 million, $3 million or something like that worth of real equity that he can just cash out and do whatever. You know, if he
go,
really
go
wanted
live on
to.
a beach.
Yeah.
So, I mean, the question is, you know, you're both property investors, and Simon, you were talking about people going on this journey to spend more time with family and kids and blah, blah, blah. For the both of you, is working in property just like a passion of, like a job and a passion?
Bit of both.
Yeah, 50-50. Look, I would say the joys outweigh the pain.
Yeah.
In any job, there's good and bad, right? And, you know, I would say the bad that we deal with actually usually ends up being good. You know, like a lot of my job is not just finding properties, but it's actually solving problems. Problems that arise during the buying process, problems that arise afterwards. and I wouldn't say this per se as a problem, but also, helping clients get their head around, or investors get their head around something like this.
Yeah.
Because no one really knows the mechanics or the variables, the thousands of variables that go into buying 9 properties in the space of, less than 5 years or so.
Yeah.
And building that much equity that quickly.
I mean, that takes a lot of research. I mean, considering how quickly some of these properties have gone up in valuation, that does go to show that you both did significant amounts of research to find the not even the correct suburb, but even the right streets.
I mean, I get a kick out of seeing people realize, that sort of light bulb moment going, okay, cool. Because to commit to Kalanga back in the day was a challenge.
Yeah.
To commit to D-Bay, Deception
D-Bay,
Bay, back in the day was a challenge. To commit to Western Sydney, in 2010, I was running around telling as many people as I could that we were buying houses out west for like nothing.
Yeah.
Everyone was like, why would I do that when I can buy in the North Shore and all this kind of stuff? So I think that's the hardest bit, right? Because every single piece of data or thing you read in the news would tell you otherwise. Don't do it. Right? But by the time it looks good,
it's too late.
You missed the boat.
Yeah, exactly.
So that's always the hardest bit. But I always say this: I've never met anyone, and I've met a lot of people that have had the option to retire. They've reached their goal, right? I've been doing this for like almost 10 years now. There's so many people that can sell down, consolidate their debt, get 100, 200K, even more passive income, live a very simple life, but they never do. Because once you get to a certain point, all you see is potential.
Yeah.
And
the needle
you just
keeps
think, what
moving.
next?
It keeps moving further.
Yeah.
And it's not about like having more and more. It's not about like, I want faster cars, better holidays, bigger house or anything like that. But you get it, you develop like a genuine passion.
This is the enjoyment of
Yeah,
it.
enjoyment.
The thrill, almost.
The thrill of finding the deal and, seeing it work and seeing it grow, and then
It opens their eyes up to
Yeah.
what more's possible.
Yeah,
Because
100%.
a lot of people have that limiting, belief and mindset so they might say, I only want maybe 3 or 4 properties. But then once they get towards that 3 or 4, they realize how much further they can go.
Yeah.
And that needle keeps moving in a good way because it's working, So
And also, for me anyway, like when people start asking you for advice, it's a good feeling, right? It's oh, okay, cool. Like I know something that someone else is trying to learn about.
Yeah, of course.
So I think that's very fulfilling for me anyway.
Yeah, absolutely. Now, Taku, what's next on your journey?
What's next? So I think my main priority is getting my taxes done, being self-employed. I need the tax
from what, 23, 24?
24s. So
Okay,
getting the 24s done.
Yep.
And then accessing as much equity as possible to go for the next round.
Yep.
So I think 2025 will be a pretty busy year for me.
Nice.
Continuing to stick to these type of properties with the good fundamentals in these type of areas that we've been speaking about. I like the idea of Melbourne, although the yields aren't historically as good, but because it hasn't really done too much over the past, 3 years or so, rents have increased, prices have stayed flat. That yield thing has started to catch up.
Yeah.
And at the end of the day, it is the second largest capital in Australia. So, might be looking in there next. But, I might leave it up to Simon as well in terms of what
To do the
advice he
research.
might give me as well.
I mean, it's how many are you gonna buy?
Depends how those deskies look.
Depends how good your research is, Simon.
Depends how good the valuations come back. So
I think coming onto the yield thing, I think there's a time and a place, right? Like Melbourne's one of those markets. Just really quickly on Melbourne, it's one of those markets where there's a lot of bargains to be had, but you need to be able to like what Taku did with Bracken Ridge, his one of his very first properties. You need to be able to wait it out. So it's all good to buy bargain, but if the cash flow is rubbish, obviously with all the land tax and all that stuff that's going on in Melbourne at the moment, that's adding to the holding costs. If you buy a $500,000 or $600,000 house and it's costing you 10, 15 grand a year to hold on to, and it's going to take 5 years for that house to make 100 or 200 grand, 5 years of holding on to a house that's costing you 15 grand, that eats up a lot of that gain that you're going to get. So you're immediately in the reds. But for someone like Taku, who's already got an established portfolio where he's got a lot of cash flow coming in, and from from business as well, you can sort of take that hit on board, or maybe put down a large deposit, or have the cash flow from other properties offset the negative cash flow in the Melbourne. So there's always like I think a time and place for everything. Might be for another episode, but a lot of people are talking about Melbourne at the moment. We are buying in Melbourne, but very sort of targeted.
Very select.
Yeah, very select.
Yeah.
And I kind of really assess where the client's situation is. I don't just go, oh yeah, let's do it. Let's get. The worst thing for me is, we'll get a great deal in Melbourne, but then if they're 6 months later, they're gonna be like, oh, Simon, I can't hold on to it anymore. I have to sell it. It's not going to be good for me. It's not going to be good for them. So what's the point? So maybe a few options. If it's 5 properties, it may be like a mix of like Melbourne and other places. But depends on what comes up, I think.
Yeah.
Focus on the numbers.
Well, fantastic. I think that's probably all we have time for today on the podcast, gentlemen.
Awesome.
Yeah.
Thank you so much for joining us. That was Taku Ekanayake, Director and Founder of Kin Financial, and my co-host, as always, on Property Unfiltered, Simon Loo, founder of House Finder. Gents, thank you so much for your time today.
Thanks for
Thanks
coming
again.
in. Thank you.
Thank you.
And we'll be back shortly with another episode of Property Unfiltered. But until next time, bye-bye.